So I was just telling Lewis that I am. I added an extra section here on speculation with perpetuals, depending on how much time we have. It's only just the preliminary results. There's no writing. It's just some results. So it gives you an idea if you're interested um, in actually trading these markets, how speculative the different coins are and the different exchanges are. So here we are. Actually, before I do this, I just want to show you in comparison. I'll just go onto the web and just look at the VIX index, for example. You can get that anywhere. So not available. That's great, isn't it? Let's see if I can get it on, say, Yahoo. So you can benchmark how these things behave just looking at equity. So I presume this is summary, historical data. Let's look at a chart. Here we are. If I just go back, say 5 years, or the maximum, in fact, we could even do that. This is the 2008 crisis, where it went up to 80% briefly. At last, it's going up, which is, for me, what it should be, because the US equity markets and bond markets, all the capital system in the US is being very manipulated by the Federal Reserve monetary policy. But, you know, it seems to have an average of around 20% volatility. It's lower than other indices. If you look at something like, I don't know whether they even maybe do the VFTSE. One of the papers I referred to, which introduced the VFTSE, is with Stamatis Leontinis. No, it's not. Can't see it. Oh, maybe there. Oh yeah, good. Okay. So this is only 100 chart, not available. But the point I wanted to make is that with only 100 stocks, the index more volatile. Something like the IBEX 35 will be even more volatile because you've got fewer stocks. You know, you can have individual stock volatility indices as well, but you do have to have a lot of options traded, as we shall see. So I'm starting off with the Bitcoin VIX again. Building on what we did with the derivation of the fair value formula. And notice the date here, April 25th, 2019. So it's nearly 2 years ago that GSR launched. They call it a hedging project, but as I said, a lot of the people in this arena of crypto assets don't really understand fundamentals of finance, and they do often use the wrong terms. All right, so I'm going to be talking about 2 papers. Well, actually, it's 1 paper and then the methodology. In the paper just published in the Journal of Alternative Investments, although it was submitted 2 years ago, it took a long time to come out. The Bitcoin VIX is what we called it, and we looked at the variance risk premium, and I will be explaining some of those results today. But then when the commercial product we developed with CryptoCompare, which I've shown you before, was launched, then the CBOE did not like the use of anything to do with VIX. So unfortunately, I mean, we called it the VXBT, and that would have been a possibility, I think. But anyway, CryptoCompare went ahead with BVIN amid all the difficulty. So this is the methodology paper, which is focusing mainly on the sort of data filtering that one needs to do, because they're completely different to the standard sort of equity options. And there's lots of features around midnight as well. There's a lot of manipulation because of something called the move contract, which sells itself as an at-the-money straddle, but is not. It's actually a physical one. Anyway, so I'd also noticed in redoing the slides, I'll send the handouts after this. I added a section on speculation, that I had conflicting notation. And so the notation you see in that document or in the paper was not consistent with the notation I used in the first part of this talk. So I've made the notation consistent with the talk, which means there'll be different notation if you look at the paper. Anyway. So let's have a look at some. Deribit, as I said, is the main options exchange. It's not a main futures or perpetuals exchange. I need to log in. They've just moved, and normally I could just go straight to, let me see if I can just go and have a look at trading without looking in. Yeah, they moved to Malta, which I thought was a bad move. They were in Amsterdam or in Holland, and sort of semi-regulated, good know your customer practices. So it takes you immediately to the perpetual, which isn't their main product. The main thing are the options, and I don't know whether you can see this. Perhaps I can make it a little bit bigger. Can I blow that up a bit? Yeah, okay. So all expirations of options, tomorrow, 1 day, 2 day, and then 1 week, and then 3 weeks, and then 4 weeks. It's a sort of very, very strange cycle. So in taking the data for a constant maturity index, one has to be quite careful. For example, 30 days, which is what the VIX is, and this is what CryptoCompare wanted to go with straight away. 30 days from now would be the straddling maturities would be the 9th of April options here and the 30th of April options. And we do an interpolation, which I'll explain in a minute, to get a constant maturity formula. So what do these options look like? Well, let's have a look, maybe more action going on the 9th of April. These are the calls and these are the puts. Calls on the left, puts on the right. Not a lot of strikes. At the money is around 5,800 at the moment, almost exactly 5,800. So you can see on the calls, you've got the high strike here, a fair amount of trading on these high strike calls, much more than you would have. They're not moving very much here, but there was some movement here. Yeah, and the implied volatility is backed out using the Black-Scholes formula. And here we have the low strike, the puts, and so these are a fairly narrow range. If we go, it's the same with other markets. If we go closer to maturity, you'll have perhaps more liquidity, mid-range. Or here you see that's where most of the trading is happening on lots of different strikes. But implied volatility of 500 down to minimum at the money around here, 85, and then it goes back up again. This is the skew shape that I was talking about, and you can also get it from the puts. I'd be very interested to see whether they have actually matched. If you don't use the right underlying, if you don't use the proper futures price, and if you use the market price of the futures, you can get some differences between the put and the call implied vols. You need to back out the price of the futures using put call parity at the money, and then you should get exactly the same. But these implied vols are completely different. Whoa! Well, that's probably because they are very stale prices. In fact, there's nothing there. We're only trading on this, only the buy side is all sell, sell, sell. But around here, one would imagine 86.2, 86, it's not the same. 86.9, 89.7, they should be the same. It's not clear how implied volatility is being calculated. And there are a few other exchanges, OKEx, Binance has started doing quite a few options as well. But very little is given in terms of methodology. We'll have a look at Binance on the perpetual side, a lot more detail. Anyway, so I just thought I'd let you have a look at the Deribit option prices. They have Bitcoin, they also have Ether options, they're still calling them Ethereum. And well, you can see that the order book is relatively active on both types of options. The CME have also started to list Ether futures and options as well. But the volume's tiny compared with Deribit. It's still the main exchange. All right, so we need to take the straddling maturities if we want a constant maturity index. So, you know, we could, for example, have the shorter maturity T1 at this strike, and that's what the options are. A few more at the longer maturity strikes. At this point in time, they were taken when the price of Bitcoin was 100 times less than it is now. No, 10 times less. I always get my zeros in the wrong place. 10 times less, but 100%. Anyway, right. So, and from those prices, we can also back out implied volatility surfaces, more than those prices, of course. Those were just the straddling ones for the VIX, Bitcoin VIX index. But just to show you from the paper that I wrote with Arben what implied volatility surfaces look like, 15th of April as opposed to 16th of June, which was a volatile period. This was a particularly tranquil period. This volatility surface moves like a sort of flying carpet. When it gets volatile, it goes up, and then it particularly moves in the tails. The out of the money puts are the ones that move first. They show that there's more volatility entering the market, and they'll usually drag this surface up. So these are interpolated using shape-preserving splines, as I explained before. Okay, so the handout, I've just changed the notation in the break to be consistent with the notation I used earlier, but it's not the same as in the paper. So we've got our fair value formula, which I derived at the end here. Okay, it's still an approximation because you've got the discrete monetarization error, which you don't have if you use a different realized variance formula. If you had, for example, the sum of the squared P&Ls, that would be what we call an aggregating formula, and you wouldn't have these variances. Anyway, I'll talk about that at another time. So the thing is that you might have a maturity of 25 days and another one of, say, 40 days, but not exactly 30 days. So you need to use some sort of linear interpolation between the two replication portfolios. So one at the shorter maturity and another at a longer maturity. And the interpolation depends on how close you are to the various maturities. So for example, if we did have, say, 15 and 45 days, then it would be a half. But then the next day, we would have two different options, one with 14 days and another one with 44 days. So you'd have to have a little bit more on the 44 day and a little bit less on the 14 day to get a 30-day constant maturity. So the weights would no longer be a half and half. They would be something like 0.48 and 0.52, and so forth and so forth and so forth, until that 45-day option becomes exactly 30 days. And then it would just be just the single formula. And then when it gets to be 29 days, you would then roll, you'd have a 29-day and maybe a 59-day or something like that. So it would be a tiny bit on the 59-day and mainly on the 29-day. And that's how it works in the S&P 500 market, options market. and any of the other major options markets, because options are traded on the quarterly cycle plus the 3 near-term months. So it's easy enough to get good 30-day indices using the monthly contracts. And if you only quote it once a day, then we only rebalance once a day. But CryptoCompare wanted a live streamed index every 15 seconds. Not only that, we have to cope with all these different expires. We don't worry about the 1 and the 2 day if we're just quoting 30-day. But halfway through our development, Deribit decided to introduce a new 3-week option, which when it's first launched has virtually no volume. So we can't use that price until about 2 or 3 days after the launch. That's why the data filtering, we have to count this omega not in days but in seconds. So this fraction will be based on the number of seconds between now and the option fixed maturity. Yeah, so that was quite a challenge, but a very interesting problem nevertheless. I'll get on to the actual implementation with CryptoCompare later. Let's just go through what we call the index the VXBT in the paper. The BVIN one is the same methodology, but it's just CryptoCompares. And we were quite interested in looking at very short-term variance swap rates, and not just with daily log returns, the sum of squared daily log returns being the realized variance, but we could have hourly or even 15-minute returns as the realized variance in this sort of market. So we explored all of that. This is the short end of the variance swap rate term structure, and you can see it goes through periods of backwardation and contango, just like most term structures on variance swaps. The same with the VIX. At the moment, the VIX has just jumped up, so we would expect backwardation if you looked at not just 30-day VIX, but 10-day or 20-day or so forth. Taking a slice through shows that the short term, this is a very, very average volatility expected over the next 7 days across the whole, using trading over the whole range of strikes available. And so that's peaked at 140% in the end of July. But it seems to be averaging around 60. And it's much more variable over the short term than over the long term, because expectations of volatility over a very long time are not going to change very much from day to day, whereas they can do over the shorter horizon. And then this is the long end of the curve, the 30 days, 60 day, 90 days. And the graph below shows the payoff to a variance swap on Bitcoin per $1 notional. So this is measured in US dollars. So for the 30 days, the variance risk premium, the difference between the realized variance over the next 30 days and the variance swap rate struck at the initiation of the swap. So for here, we have to stop here because we need the last 30 days to calculate the realized variance. And so this variance risk premium, of course, we don't know it until the end of the swap, but we can use historical data to see what it would have been had you entered a 30-day variance swap at exactly this point. You would have had a fair value swap rate of 63%, and your payoff would have been something like minus $100 for every $1 notional on the swap. For the 60 days, we need 60 days, so this series ends here. And similarly, for the 90-day, to get the variance risk premium, we need a sum of squared log returns over this 90-day period to calculate this number. But as you can see, the variance risk premium is a little more balanced than it is on equities. If you know about the VIX variance risk premium or any other equity index, it is typically very small and negative, and occasionally becomes very high and positive. Whereas for Bitcoin, because of the way volatility behaves, which I've already alluded to in my first course on Tuesday, there is a lot of volatility when prices are high, as well as in a sort of bubble regime. In the high volatility regime, we have a reverse leverage effect, and I'll get onto that later. So what this means anyway is that people who want to issue variance swaps, typically in equities, the issuer would be a bank that wants to short volatility because they've written, they write a lot of options which are long volatility, and so variance swaps will be short volatility, and so they can balance their volatility exposure. So they're happy to write variance swaps. But GSR and other market makers in Bitcoin options are not writing Bitcoin options. Sorry, the other market makers in variance swaps are not writing Bitcoin options, but they should find a more balanced demand. People are not just going to be wanting to buy realized variance. A lot of people will want to sell realized variance, as you can see from the features of this risk premium. So one of the blogs somewhere, I may not have got it on my website, but I did write something called, I think just on LinkedIn, about the variance swaps on Bitcoin being more of a fair bet than on equities. So this reverse leverage effect, what do I mean by that again? Well, going back to those Garch models where the asymmetry term was typically the gamma coefficient was negative, meaning volatility increases following a price fall more than it increases following a price rise of the same amount. The falls of 10% give you a lot of volatility. The rises of 10% don't give you a lot of volatility. But in Bitcoin, we have these two regimes. We have the normal regime where prices are low and the falls in the Bitcoin price will induce more uncertainty, more further volatility in the market. But we also have this is only up until the end of last year. Bitcoin price was still under 20,000 at that time. I need to do another blog on what it is at the moment. Here you can see that these price rises were increasing the green line. You see this price hike is making the Bitcoin VIX go up. So let's have a look at the live streamed BVIN index, see what it's doing at the moment. I can't remember where I took this snapshot. But I'm pretty sure it's come down now because the initial rises are okay, right, it's just jumped up there. This is, I mean, I have to continually look at what's happening with Deribit, and I haven't had a chance. Just the last day, about 9 o'clock this morning, no, 8 o'clock this morning, yep, it's done. They've gone and done something with their issuance. So it always happens at 8 o'clock, 7:50. Yeah, I don't know exact. So around that time, Deribit did something strange on their issuance of options. When I have a moment, I am talking to CryptoCompare quite a lot anyway. So, but if we have a look at the year to date, we've had a number of times. So this is 15 seconds. Okay, it's just being updated. Doing it every 15 seconds means that the data filtering, and some of these things are real, others are just a feature of the data coming from Deribit. Anyway, so this has only been going a few months. It started at the beginning of December. It's much higher, of course, than equity volatility, but the Ether one, we can do that as well. The liquidity on Ether options is good enough. Is around 20% bigger than BVIN. Okay, so now I'm going to move on to the next part of the talk, talking about perpetual swaps. So these contracts, which I think I mentioned in the price discovery, part of Tuesday they're like futures, but they have no expiry. Instead, there's a funding rate mechanism, which means that obviously for every futures contract, for everybody long, there's somebody short. You know, if I buy one futures, then there's somebody else that sold that futures. I might buy 5 futures and somewhere else somebody sold 1 and another person sold 4, sort of thing. Yeah, that's how the market makers match. And of course you can only do integral number of contracts, but on BitMEX and Binance, the notional value of each contract is tiny. It's like $1 for the BitMEX, and I think it's 10 or something for the Binance. Anyway, so because there is no expiry date, something has to tie the value of the perpetuals to the spot price, and that is the funding rate. Now, most of the time over the last 6 months, because of this incredible surge in price of Bitcoin, as you can see, going from 11,000 in October to touching 61,000 at one point just recently, the funding rate has been positive, which means those people who are long the perpetual have to pay those that are short the perpetual. And the funding rate mechanism is something I'll go into in more detail. It's very complex. How the funding rate is derived is, as I said, these people, it's a different calculation on every exchange. This just shows the BitMEX and the Binance ones, so those are the main ones. But the point is that it can be, when it's quite high, like 0.5% of the position you have, it can be quite a deterrent to being long. And so when the long payment is when the futures is above the spot, and so it goes negative. It has been much more negative than that, but at the moment not very much. But when it's negative, it's because the perpetual futures is below the spot. So that's one of the features that distinguishes them. There are many others. So this is an unpublished paper, work in progress, with Jun Deng and Bin Jun. Bin Zhu, sorry, there's a typo there. I'll correct this before I send this to your the handouts. His name is Bin Zhu. He's from the US, and Jun Deng's in Peking. So this funding rate mechanism, you can get details of, just clicking this link, of the Binance funding rate. So real-time update on different types of perpetual. You can see the funding rate can be 0.2, it's generally less than 0.5%. And look at all these different perpetuals. You can trade almost everything. Engine coin, I haven't heard of half of these. The Binance Launchpad now allows most coins that are good enough to go, most ICOs can go straight onto this board of perpetuals. Sushi Swap here. Anyway, IOTA is one that I think people should watch. It's a very, very interesting blockchain with the consensus algorithm. Oop. So I've already said that a positive or negative rate gives the peer-to-peer payment. So if I'm long 4 contracts, I have a certain funding payment to make, which the exchange platform will then distribute between the person who's shorted 1 and the person who's shorted 4, if you see what I mean. So they're an ideal hedging instrument for Bitcoin miners. And what do Bitcoin miners do when the price is going up like this? They're not going to convert them to dollars. They're going to hold them, but they may want to hedge against any fall in price as well, rather than speculate on their own income. And there's very, very high leverage. I already mentioned that on Tuesday, even 125 times in some cases. And because there's so much leverage, it means that very large notional positions can be taken on perpetuals. And the higher the leverage, the more likely you'll have a margin call. And how do these exchanges deal with margin calls? They're not like standard exchanges, which would probably give a day to see whether the call was covered. And it may be that preferred customers may have that. I was speaking to OKEX about how they do it, and some preferred customers don't have to be booted out like any old traders. But the margin mechanism, this is from the Deribit Perpetual actually. So the Deribit Perpetual margin mechanism and the mark price is supposed to smooth those forced liquidations. And it does quite a good job of it as well. The problem is that if your trading losses exceed your maintenance margin, then you will automatically and incrementally lose your position. You see, these positions are so tiny that, you know, there's no position risk as there would be on, say, a gold futures where, you know, you'd have to hedge with exactly 1 or 2 or whatever, you know, and the value of each futures is so high that there's a very big position risk. Here, the position risk is a different sort of position risk. You can probably get exactly the sort of size of contract you want for hedging. However, you may have a forced liquidation if you don't have enough buffer in your margin account. So settlements are very regular. They take place every day at 8 o'clock in the morning, and it's the same for all of those exchanges. It's always 8 o'clock universal time. And the realized and unrealized session profits, which I'll talk about in a minute, they're added in real time to your equity, but you can't change your margin account until 8 o'clock in the morning. And then if you want, you can withdraw funds from the margin account. So the initial margin is minimum, obviously, minimum margin is only 1%. So if I wanted to take a position of 100 USD, so 10 perpetual contracts, I would only have to put up $1 if I wanted. But then, you know, if I've got 100 USD in value, as soon as it falls, depending on how much I've got in the margin account, if I've only got $1, as soon as it falls, I'm going to have a margin call. And so I have to put in more than the minimum margin typically. And now traders are known, can be spotted as you know, people on 50 times leverage or 20 times leverage traders, according to people that I talk to that actually trade these products. So there's a tiny increment. It's not exactly 1% for the initial margin, but then the maintenance margin is even lower. So, so you start off with your initial margin, and then if the losses made fall below the maintenance margin, this adjustment is tiny, but if it falls below that, then you would have to top up your margin account or be liquidated. So forced liquidations are very, very common, particularly when prices are very volatile. And one of the ways in which exchanges prevent this happening is having something called a mark price. And there are different calculations for different exchanges. So the mark price here is some index, which I'm not going to go into the details, it's too detailed for this course, plus 30 seconds of an exponentially weighted moving average of the difference between the perpetual and the index price in this case. So we have actually looked at all the mark prices and calculated them ourselves because you can't actually download them. and then had a look at histories. These results are in process. Okay, so we're doing a lot of different analysis, and I haven't got an updated graph at the moment. But these show the long and the short liquidations on different exchanges. If you just have no particular buffer, and according to the mark price. So you can see that these liquidations are going to be generally lower on the BitMEX, apart from, this was March 12th, when there was a massive liquidation on that day in BitMEX. Half of the positions were completely wiped out. And then on Crypto Perpetuals, they are the least likely to have forced liquidations of long or short positions. And then the probability of having a margin call. Here we suppose the trader opens a long or a short, put a short up here, long position with a certain amount of leverage, okay? So the more leverage, the more likely you're going to have a margin call. For example, if you've got 100 times leverage, within 15 days, you're 93.41% certain to have had a margin call. And this is using the BitMEX perpetual futures, using these probabilities, just historical probabilities like default rates, from the 1st of January 2017 to the 31st of January this year. And obviously the probability of a margin call will increase as the time that you hold the position increases, and also with the leverage. So if you only hold it for 8 hours, 8 hours being the funding rates are reset, and the funding payments are made every 8 hours, 3 times a day. So that's why we look at 8 hours and then 1 day, 2 day, 15 days. Very, very small probability if you were short, but much more likely if you were long, showing that large price falls are still more common than large price hikes in this market. But this is over a very long period. And later on, I'll be looking, if I have time, I've added this section with speculation and perpetuals, where we can look at things as time series. All right, so how do you formulate a hedging problem, a mean variance hedging or something like that, by also including the probability of a margin call? So suppose the platform monitors the margin at discrete intervals, say delta t, and that's the regularity with which they will check for margin calls. It could be every hour. It depends on the exchange. And we also suppose our Bitcoin miner, our hedger, holds 1 Bitcoin at time t and shorts theta, which obviously depends on t. I should put a subscript there, but okay. They're just formulating one problem at the moment. Shorts theta units of the futures to hedge spot price volatility until this is our hedge horizon, capital N delta t. So we hold 1 Bitcoin, so we lose if the USD price of Bitcoin falls. And so with our hedge, we want to win when the UST value falls. Otherwise it wouldn't be a hedge, okay? And why did I say that? I mean, that's pretty obvious, isn't it? You're long Bitcoin over USD, and your hedge should therefore gain when the USD value falls. Because there are 2 different types of perpetuals, and in fact ordinary futures as well. There are what we call direct and inverse futures. So the futures that I showed you for the price discovery study were all inverse futures. In other words, they were not denominated in USD, they were denominated in Bitcoin. So whereas an ordinary, like the CME futures, the value of it's 1 Bitcoin denominated in USD, these futures, the inverse futures at least, are like $1 denominated in Bitcoin. Okay, so I'm going to denote those prices FT and F hat T. And if we're going to be hedging with inverse futures, and the reason we are is that these were the first ones to come in. Most of the trading volume is still on the inverse tether futures, perpetual futures. Later on, USD futures were introduced and direct futures. But so anyway, now we look at the end period different from the time T where we open the hedge. So this difference is not just a 1 period difference, this is the end period difference operator, okay? This is measured in USD. And similarly, we take this the other way around because it's measured in Bitcoin. And this is the start price minus some end price, because then, only then, will a short position profit from a decrease in the USD value. So we have to take this the other way around. It doesn't really matter to do this unless you're looking at hedging, but it really matters to get it the right way around when you're looking at hedging. Plus we have to multiply it by the Bitcoin USD value to convert it into USD. So that's why you can see this term at the bottom here. This is the hedge position and the P&L on the hedge. We're short, this is the P&L, and we multiply it by that. So the realized P&L, that means this is unrealized until little n reaches capital N, and then it's realized at capital N. That's what it is. Okay, this is the underlying, and this is the hedge. And so the basic problem, without any margin calls, would be to choose this theta to minimize the variance of the hedge portfolio. And we'll call that variance sigma squared delta H. So it's the variance of the P&L on the hedge portfolio, sigma squared delta H. But what about margins and liquidations? Well, you need a margin account and you're hedging 1 Bitcoin. So you don't have to put a whole Bitcoin into your margin account. You could use leverage, which will be given by b to the minus 1. So this is b is the initial margin requirement, like 1%, but it might be more like 5% or 20%, plus some sort of buffer so that you don't keep getting bothered with margin calls. And then the margin account is marked each delta t using the marked price, okay? And so at that time, if the change in marked price of the inverse future is less than 0, there'd be a marked gain. And if the change in the marked price is positive, there'd be a marked loss. So this thing here is the cumulative, because as n increases, it's a cumulative thing. It's the unrealized gain or loss. Settlement, as I said, is daily. So if you've got a maintenance margin, M, which will trigger, if it falls below the maintenance margin, that will trigger a margin call. The constraint on the ability to meet the margin call is your buffer minus the maintenance margin. And then you'd have a forced liquidation if the gain or loss exceeds, well, if the loss here, so if this is positive, there's a loss. If the loss exceeds your ability to meet the call at any point n before you close out the hedge. So what the hedger wants to do, as well as minimize the variance of the hedge portfolio, is to minimize the probability of a default event. Default will only occur if there is a marked loss here which exceeds M for some N in the period. In other words, we need to look at the maximum value of these N period differences, and the probability of a default, of a forced liquidation, will be the probability that your position maximum loss exceeds your upper constraint. So to put them all in one objective, we introduce a default aversion parameter, calling it gamma, and we also multiply this default probability by the variance of the underlying so that they're in commensurate units. And obviously the more averse to default you are, the higher the parameter gamma. And so our results will depend on different values that we assume for default aversion. And anyway, using the extreme value theorem to calculate this probability, we get using a generalized extreme value distribution result due to Paul Embrecht's, we can derive this optimal theta, and the best way to express it is pretty complex. The derivation is in an appendix of the paper, but this term here comes from the extreme value theorem, and the others is just a lot of algebra. So what factors influence the optimal hedge? Well, first of all, there's the ratio of the end period spot and futures P&L volatilities. This could be quite close to 1, but in fact, whereas spot and futures are very, very highly correlated on things like S&P 500, so highly correlated there's not a lot of point in using a minimum variance hedge, because that's only going to be useful when you've got the actual futures and you're not using a proxy, if the correlation is much less than 1. I mean, like 0.9, it might be useful not to have a naive one-to-one hedge. But this thing can actually be quite different to 1. And then this B in the numerator is, so this B is just like the ordinary beta hedge ratio, the covariance divided by the variance. And these constants, alpha, beta, and tau, are the scale, location, and the right tail index, because of the way we've formulated the hedging problem, we're looking at the right tail index rather than the left tail index parameter of the distribution of the extreme values. So we have to estimate these parameters somehow, and the most important one will be the tau, the tail index. So let's have a look, before we do some empirical results, at the variation of the optimal strategy with the tail index. As the tail index increases, large price moves become obviously a lot more common, and default probabilities increase, and so the optimal strategy increases. The theta goes from 0.4 to 0.7. This is for fixed values of the buffer, 20% for default aversion, and assuming a correlation of 0.9. The default aversion parameter, we look at it from 0.5 to 4, with a tail index of 0.2. The more averse you are to default, the less you are going to hedge for these fixed parameters. The margin constraint, as M increases, if this increases, you can also increase that for any process there. So the margin constraint, as M increases, so will your hedge, and correlation will increase, but we haven't gone as far as a unit correlation. I think, as I said, these results are a bit preliminary. I'm going to redo the graphs. Okay, so the latest data that we've been using are on BitMEX, Bybit, OKEX, and a few other exchanges as well. I think we've been through about so many iterations. It's such an enormous problem. So just looking at trading volumes on these perpetuals, overall, most of the volume was on BitMEX, but more recently, Bybit has got at the moment, BitMEX is really losing ground. Bybit and OKEX, and even more recently, Binance, as I said, just come into the frame on the Bitcoin as well as others. So the data information is that we're using 3 different exchanges, prices on those, assuming that's where our spot Bitcoin is held, and then 3 different possible exchanges to hedge. Many more observations on BitMEX than the newer exchanges. So, just getting a common data period is, unfortunately, when we look at cross-exchange analysis, we were only looking at BitMEX at first, but it does cut down the number of data points available quite a bit. So the correlations, as I said, are quite low, even across the spot exchanges. These are 1 minute change. Everything is done at a 1 minute frequency, as you will see in a minute when I talk about the way that we estimate the tail index parameter, which is the crucial parameter for our hedge ratio, as well as these correlations, as well as the relative volatilities. So the highest correlation is between Coinbase and these futures, 0.95 and 0.96. Across the perpetuals, there's much higher correlation than there is on the spot. That's to do with frequency of trading volumes, because so much, I showed you the graphs on Tuesday about how derivatives trading has really overtaken spot trading, and most of that derivatives trading is on these perpetuals. So it's not surprising that we get much higher correlation there than we do in this sector of the matrix between the spot exchanges. So how do we estimate the tail parameters? Well, this is just an illustration, assuming that it's just 30-minute monitoring and for the margin calls, and a hedge horizon of 5 days. But these are parameters that we change in our program. So we estimate these generalized error distribution parameters based on 210 daily extreme values. So over the last, every day, if it's 30 minutes, there are 48 30 minutes in a day. Yeah, 48 minutes in a day. And so we look at the change over the first 30 minutes, the change over the next hour, and so forth and so forth. And it's the maximum of all these that we need to use for our tail index estimation. And so we get one maximum, and then the next day we get another maximum, and we get another maximum, and so forth. And so we need at least 210 maximum values in order to estimate the parameters alpha, beta, and gamma. We've tried it with less, but 210. We may change it to 200. I don't know why. It's Jun that did this. Why he initially chose 210, but we're trying to reduce that and still get robust estimates of these parameters. And as I said, the most important parameter to estimate is the tau, the right tail index. Here's some results on the tail index estimation. So we're seeing a positive, so the generalized extreme value distribution is a Frechet, and when the tail index is positive, it always turns out to be positive. And it seems to be pretty good for the direct futures and the inverse futures across the different exchanges. And except on the spots, where Gemini is quite different to Bitstamp and Coinbase. I'm not exactly surprised, because Gemini isn't a prime trading venue for Bitcoin. Okay, so those are the right tail index, averaging around 0.6 or something like that. And then we compute the optimal hedge ratio. There's a lot of graphs I haven't included here. Let me see what the time is. Yeah, I shouldn't go on too long about this. Just to look at the hedge effectiveness of Bitcoin perpetual futures, how varied it is, depending on what underlying you're hedging, what perpetual contract you're using, how long you hold it for, and how big your buffer is. So obviously, and it also depends on your particular default aversion. So we should have some lines here. Let me just take Coinbase as an example, with a reasonable size M margin buffer here, and with the effectiveness is pretty high across all of them. The effectiveness is just the reduction, the variance reduction in a unhedged position compared with the hedged position, and you can reduce the variance pretty well, particularly if you rebalance every 8 hours. The more averse to default you are, the less you'll take in your hedge, and then the hedge effectiveness goes down. And the smaller your buffer, the smaller the hedging effectiveness. Overall, it looks like OKEx is perhaps the most effective exchange to use, whatever the underlying, and rebalancing every 8 hours is always going to be more effective if you rebalance and you have to settle, which is a bit of a drag. If you don't settle, holding it for 2 days, you're still going to have a problem, because it's more likely to be a margin call. So now, in response to Michelle's question this morning about speculation, I thought I would, and also thought I would have time anyway, which I do, to look a little bit at the preliminary work I'm doing on speculation. So that's the next part, also with the same co-authors. We'll put all this in one great big paper if we can. The trouble with research in this area is you have to be quick, and you have to keep updating things, and when you update things, things change. I said that already on Tuesday, that so many papers come to me on crypto and they're out of date. They're so quickly out of date. Anyway, so now we are looking at different types of perpetuals, and just have a look at these contracts. These are the USD denominated, and there are also USDT denominated perpetuals, which behave quite differently in terms of speculation. So USD denominated perpetuals are available on Binance, BitMEX, Bybit, Deribit, and OKEx, and many, many others, but these are the main ones. The biggest volumes are on Bybit and Binance. This is an average, though, over an entire period. If we looked at a time series, the BitMEX would be much lower, OKEx would be much higher. We don't have so much data on some of these. The OKEx started in 2020. It goes up to the 9th of March, just last week. These, as I said, these results are very hot off the press. They go back further on BitMEX, but not as Binance are really the new kids on the block. So mean and median gives you some idea of how skewed these things are. So what we're looking at is the volume measured in $1 billion and open interest in $1 billion, mean and median, and also in $1 million, that's M, the short liquidations and the long liquidations, and overall. That's the sum of the two. So you can see that there are a lot of short liquidations on Binance, a lot of long liquidations on BitMEX, but these results are not right. I need to clean them, put them over common periods, and yeah, do a little bit more with these data. It gives you an idea, though, about the sort of statistics across different exchanges. Deribit is tiny. OKEX is much smaller. So Binance, BitMEX, and Bybit are the biggest ones. And these also, and OKEX, have USDT tether denominated perpetuals. And here you can see the volume is much bigger on Binance, tiny on the others. So it's the Binance tether. Binance is basically a tether exchange. It's only recently started USD. And the Binance Tether USD swap is something else. Yes. Anyway, lots of liquidations in the Tether denominated. It's obviously a much more speculative instrument, and we can measure speculation. In fact, I found a paper recently which used just the ratio of open interest to volume as a speculative index. Apparently it goes back years, but actually you can measure the average holding period just by using the ratio of the open interest to the volume, or half the volume, because for every long and short it's counted twice. I mentioned that also on Tuesday. But the speculation interest, the speculation is, they don't divide the volume by a half, it doesn't really matter. Actually I've got this wrong, I just did these slides over lunchtime. It's the volume divided by open interest, which increases as there's more speculation, whereas the average holding period decreases as there's more speculation. So that's why we're using it this way around. Sorry about that typo, I'll change that as well before I send you the handouts. And you can see, forgetting at the beginning here, that Binance USD or Binance Tether, so this is every 12 hours, these speculative indices are calculated using the 12-hour open interest and the volume traded over that 12-hour period. So obviously there's more speculation on Binance, as we know. It changes over time. There's more speculation on the Tether products. You can see this index is not exactly the same. As I said, these graphs are just very preliminary, just whilst we discuss our results. And Bybit is the least speculative. The other exchanges are 5 to 10 times more speculative than Bybit. And here, Deribit is the least speculative, and the other exchanges are, again, maybe twice or 5 times more speculative than Deribit. That's just for Bitcoin. Later on, we can look at how within Binance, how speculation differs across the different perpetuals. As I said, there's so many of them. How would you choose which ones to trade? So that time series can be summarized here. Just let's look at the common dates. Again, not even the same common date for the Tether. That goes back further than the Binance. So I mean, everything needs to be really over the same period. This one here, just from August until now. So this shows, using the common date, that the median and the mean are much higher on Binance, and we can really compare these now. BitMEX is not as speculative as Binance. Bybit's about the same as BitMEX, and the others, well, OKEX has quite a lot of speculation. But when I say speculation, you have to be quite careful with some of these exchanges, particularly when they have the fee rebates. So with Binance, because of Binance Coin, there could be quite a lot of wash trading. People setting up accounts either side and just trading against their own account, trying to keep the price stable, not move the price, but just hiking up the volume. But because if they're making the market, they get Binance Coin, it's effectively a way of mining Binance Coin. And most of these exchanges, apart from Deribit, have quite a bit of wash trading. So certainly on OKEX, I know there's a whole CryptoCompare exchange review, but also there was a big report on wash trading by some asset managers, not Great Southgate, but the other ones beginning with B, about a year ago, sort of calling out exchanges on this wash trading. It's much less than it used to be, but it still is affecting this, what I call the speculative index. It's not just people trading very quickly for making profit and loss, it's actually just earning the exchange coin. Okay, so it's similar across these exchanges, more on the USD than the Tether on Bybit, but that's because there's much more volume on USD on Bybit than there is on Tether. And the Tether one on OKEX has more speculation than Bybit. So what about looking within Binance across the different coins? And we've just taken some of the main, more established coins. So this is Cardano, this is Bitcoin Cash, this is BNB, Binance. No, what is BNB? I've forgotten. Sorry, I'll have to look that one up. Just escapes me. Bitcoin, Dogecoin, my favorite, DOT, Ether, Litecoin, TRX, no, I'm sorry, I should have looked this up, and Ripple. And so on the USD Tether, we see that the largest average speculation is Dogecoin and Bitcoin, much less speculation both in mean and but the maximum, there can be speculation on these coins like Bitcoin Cash, BNB. The maximum value can really change. Whereas, and in Dogecoin, well, that's because we've got this whole period, and Dogecoin is a strange coin. It goes to sleep and then suddenly it wakes up and starts barking. So most of this period, I've asked Jun to take Doge out of this because it's not doing anything for a very long time. So it's not surprising that we've got this type of result. So against the USD perpetuals, there are fewer of those. Most of the perpetuals are Tether perpetuals. And here you see that Ripple and Cardano are the most speculative coins on Binance on average. And again, this should be volume over open interest. I'll correct that. What about, are they being speculated at the same time? Are people speculating on one coin and then moving to another coin? Well, these indices, these correlations are quite strong. Again, these are terribly preliminary. That's why I wasn't originally going to be covering this. And not surprisingly, the highest correlations are between Bitcoin, Ether, and Litecoin. Those are the three main coins. So it looks like it's the same activity going on these coins. And the wash trading is more likely to be on the little coins, which aren't included. I've only looked at the main coins here. On the USD perpetuals, though, it's really the speculation is much more on the Tether perpetuals, as I already showed you. It's mostly Tether that's being used for that speculation. It all fits with the story of Tether being printed without proper collateralization, being pumped into the system now on, it's not just the OmniAir now, it's on Ethereum, it's on Tron, it's on many different blockchains, so it's really hard to use the explorers to find out where it's coming from and going to, but it's certainly a lot of it is ending up in Binance and being used to speculate on the Tether perpetuals. Here, apart from Bitcoin Ether, where of course you're going to get a lot of high correlation, we've even got negative correlation, and there's a very high correlation, not quite sure what this one is about, between the BCH, Bitcoin Cash, and Litecoin. These are sort of still top 10, but not the, you know, not the real 5-star coins, Bitcoin Cash and Litecoin. Right, so that's all I have to say for today. I'm happy to take any questions. Over to you. Is it Anna? Hello. Is anybody there?
Hi, Carol. It's Amalia.
Hi, Amalia. Hi. Yeah. Hi.
I don't know if Ana Aparicio is in. Let me just check.
Okay. Yes, okay? I'm here.
Okay.
Good afternoon. Good afternoon, all of you. So I was looking for Lisa, but we can't.
I'm here.
Okay.
Hello, everyone.
So we are all prepared to say your goodbye. So I give the word to Lisa. Okay.
I was looking at the chat, so I don't see questions. I don't know if there is someone wants to make some question or comment. Oscar says that he did a question this morning, but I don't know if we is already reply this question.
If I answered it satisfactorily, then there weren't a lot of questions on Tuesday. Oh, any chance to make money with the funding rate? Yes, sorry, thank you for reminding me. So we are using some standard causality, like Granger causality type regressions